Thank you. Good morning, students. A very warm morning. Yes, it may be chilly out there at your place, but still we can feel the warmth with the subject. We can feel the warmth with the new year. We can feel the warmth of the dreams that we all are pursuing of becoming a quality professional, of becoming a legend of our subject, of our field. All these things gives you that warmth, gives you that energy, gives you that power to escalate high. And this is what should be your primary objective whenever you are looking at your career. It should be the sole purpose of being the best, the sole purpose of reaching the height of the career and the depth of the subject. So, with this warm wishes of the morning as well as of this Gregorian New Year. So yes, very good morning, Neeraj, Shamli, Prerna, Achita, Linga R, Navneet. Very, very good morning to you all. So let me first start with our regular ritual of taking your queries, doubts, if any, in the topic, because now we have completed 70% of the portion. Today we'll also deal with some practicals to abreast ourselves with the provisions in more depth. So let me first go through your questions, queries, any particular page from the module, any particular provision. Yes, students, tell me. There should be queries. There cannot be a situation, at least in this chapter, where you don't have queries. If you don't have queries, there is something which is seriously wrong. Or it suggests that you have not at all gone through this topic post our previous lecture, which is not at all a good sign, students. You have to read by yourself so that you develop your own understandings, maybe misunderstandings and confusions. So we are here to handle that. But for that, you have to first take up the subject, the topic by yourself. So Neeraj is asking, Ki sir, when I read, I found that when an individual sells his house, it is exempted. See, there is no automatic exemption. Today, we are also going to go to the exemption sections. See, there are two types of exemptions. Pay attention to this point, students. For the entire act, there is section 10. I'm sure you all would have gone through section 10 provisions in your earlier topics. So, one is the section 10 exemption, which applies throughout. Throughout means you'll find that those are the incomes which will not be considered as income or taxable for the entire act. So section 10, you can say, is the generic exemption. Then you have something in this chapter called as specific exemptions, which are covered in section 54. So if I have to give you the provisions here, ठीक है. I'll give it here. So let me call it as exemptions from capital gain. So first is you have section 10 provisions where, like all other heads, you have some incomes which have been made exempt. And then you have a specific exemption provision for capital gains in the form of 54. Now within 54, you have multiple sections: 54, 54B, 54C, 54D, 54EC, 54F, etc. Now, what is the difference? When anything is falling under section 10, it is not income in the first place, or it is not to be included in total income. This is what section 10 says: incomes which do not form part of total income. So these are, you can call it as exempt right from the source. However, Neeraj, what you read is relating to 54. Now 54, which is a special or specific exemption for capital gains, is not happening or is not attracted automatically. All these exemptions under 54 applies after you have reinvested your capital gain or the amount received. So what is the difference is that section 10 is outright exemption, and 54, which is a special exemption crafted exclusively for this topic, requires you to reinvest. So first we complete the capital gain calculation. So in our format, see, format. So in format, you'll first reach here, that is capital gain or loss. And after you find that there is a capital gain, you go to 54 to check if there is any provision given under 54, whereby after reinvesting the amount, you are given the benefit. So that is what I think, Neeraj, you would have studied or read relating to residential house. Fine, beta? Good. Okay. So students, we are studying capital gains. In capital gains, we are in this format. If you recall, in the previous class, we have completely covered cost of acquisition, cost of improvement. Expenses on transfer, there is not much to be read. Now today we are going to study the last part, that is what is full value of consideration, plus what are the section 10 exemptions under capital gain or for capital gain. These are the two things that we will study, and then we will proceed to solving sums. Now, these were the provisions that we studied in the previous class relating to cost of acquisition. So what is the general rule for cost of acquisition? Section 55(2) says, the general rule is cost of acquisition will mean the cost, that is the price at which you have purchased or constructed your capital asset, plus all expenses that are incurred until the asset becomes ready for you. So this is something very similar to your accounting provisions. Then, as a rule, you have exceptions. Now in exceptions, first we have golden rule 2, which says that in certain cases, your cost will be cost of previous owner or the previous asset. Now, when will this happen? So for this, what is our golden rule? Our golden rule is whenever you have acquired the asset in such a form which is not treated as transfer under section 47, in those cases, where your asset is acquired in one of the mediums which is not regarded as transfer, in such cases, your cost of acquisition will be the cost of previous owner. Similarly, in those cases where you receive the asset in exchange of some other asset, like conversion of bonds into shares, preference shares into equity shares, or at the time of amalgamation demerger, you gave old company shares, you got new company shares. All these are also not regarded as transfer. So in all these type of cases of exchange, your cost of acquisition of the new asset is the cost of the old asset. So these are all those exceptions which fall under Golden Rule 2. Then we have some more exceptions. Then comes the exception which I call as Golden Rule 3. What is my Golden Rule 3? So wherever at the time of receiving asset, if some tax was levied, if that receipt became taxable under any other head, then my Golden Rule 3 says, now what will be the cost? Now the cost of that asset will be that value which at the time of receipt of this asset was considered as income under any head. So under this comes securities or shares which are received as ESOP. They are taxed under the head salary by taking the FMV on the date of ESOP grant. Similarly, where the asset is received as gift and the gift is taxable under other sources under 56.210, then whatever value is considered over there in 56.210 will be considered as the cost of acquisition here. Now, what is the value considered over there? For movable, it is the fair market value. For immovable, it is the stamp duty value. Similarly, when you convert your stock in trade into capital asset, that income is taxed under section 28, that is PGBP. If it is taxed, then what will be the cost of this capital asset? It is the value which is considered as income over there. And what is that value? It is the FMV on the date of its conversion. Similarly, where the company is going under liquidation and that company has given away some assets to you, in such cases, what is the value of that asset which is considered? It is the fair market value on the date of distribution. So these are some provisions falling in Golden Rule 3. Then you have some special provisions of cost of acquisition. So for intangible assets like goodwill, trademark, copyright, if they are self-generated, cost is nil. If they are purchased, the cost is the actual price paid. For financial assets like share, debenture, bonds, if it is right shares, it is the actual cost of purchase. If it is rights, it is nil. If it is bonus share, it is nil. This second part is dependent on the other provision. What is the other provision? The other provision is if your asset was acquired before 1st April 2001. So where assets are acquired by you or by your previous owner before 1st April 2001, then for such assets, the rule is except land and building, for other assets, the rule is what will be cost? It will be greater. It will be higher of your actual cost or the FMV on 1st April 2001. In case of land building, it will be what? It will be higher of actual cost, but then the other part is comparison of two values and taking lower of the two values. First is FMV on 1st April 2001. Second is stamp duty value. Compare both these, take whichever is lower of both these values, compare that lower value with your actual cost and take whichever is higher. And that is how for bonus shares, this rule has come. So if bonus shares are acquired after 1st April 2001, the value is nil. If it is acquired before 1st April 2001, then the value is the FMV on 1st April 2001. Then comes cost of improvement. What is the general rule? Cost of improvement simply means in our accounting language, the capital expenditure that you have incurred. So whatever is the capital expenditure incurred after the asset is acquired, that is your cost of improvement. So whatever capital expenses you incur for increasing the life of the asset or the value or the worth of the asset, that is cost of improvement. Now this rule has exceptions. In case of intangible assets, cost of improvement will always be taken as nil. Then if the asset is acquired before 1st April 2001, we don't have a problem with such asset. But if cost of improvement is done before 2001, that cost of improvement has to be ignored. That is, you will take it as zero. So in these two cases, cost of improvement will be zero. Then coming to some special cases of capital gain. The first special case is where what you have transferred today is a depreciable asset, and this depreciable asset is forming part of block. In such cases, section 50 applies. Now, section 50, subsection 1, subsection 2 says what? That in case of a depreciable asset, which is part of block, is sold, then what will be the amount which will be taxed as capital gain? For this purpose, 50 bracket 1 bracket 2 says that firstly, capital gain will arise in cases of block of asset only if either WDV of the block becomes nil. Now, when this will become nil, WDV will become nil when the sale value of the asset exceeds the total cost of the block. So the block's WDV becomes nil, then you will compute capital gain, or where the block itself becomes empty. Now, when will be the block becoming empty? When you have sold off all the assets that was part of the block. So the number of assets is zero. Now, students, you have to be logical because it is difficult to learn each and everything. But logically, if you understand, then it is easy to retain the points. What is the logic? The logic is simple. This is our format of block of assets, which we studied in PGBP also. Opening plus purchase minus sale. After this, what is left is called as WDB as per section 43 bracket 6. Now, if the block has some value also left and some assets also left, you calculate depreciation. Then in such cases, even though some assets are sold, there will be no capital gain loss computed. But where in the block, either the value has become zero or the number of assets has become zero. In both these cases, logically, where there is no asset, there can be no depreciation. Where there is no value, there can be no depreciation. So that is how you get the answer of 50 bracket 1, 50 bracket 2. What does 50 bracket 1 and 50 bracket 2 says? That either where the WDV of the block is zero or the number of assets in the block is zero. In either of these cases, there will be no depreciation. Rather, you will compute capital gain. Now, what is very important is the law has presumed the capital gain or loss arising on sale of block of assets as always short term. Then the second special provision which we studied was of slump sale. Now, in case of slump sale, what is important? You are a business which is having multiple divisions, multiple branches, multiple units, and you are selling off one of your divisions or branches. Now, when you are selling off one of your divisions or branches, then the law says we compute capital gain of that entire division or that branch. It means in such a case, the law treats that entire unit, that entire branch as your capital asset. Now, this is very important. If it is a slump sale, when it is a slump sale, when the consideration is fixed lump sum. So you have fixed consideration for that whole branch, 500 crores. That is slump sale. Now, in such cases, capital gain has to be computed for that entire branch, entire unit, and not for each asset separately. Now, in such cases, two things are important. Firstly, what will be the full value? And second is what is the cost of acquisition? Now, for both things, the logic is we don't have to look at independent assets. We have to look at the whole branch or the whole division. So in this case, the law says the full value of consideration will be the FMV. Now here, when we go to the provision says you have to take higher of two FMVs. What are the two FMVs of which you have to take higher? One, where you have sold a branch or division. Find out the FMV of all the assets in that division or branch. Take the FMV of that branch assets, one. Two, when you have sold this branch or division, you would have received some purchase consideration, which may be in the form of money, shares, debentures, or any other asset. Find out the FMV of that. So two FMVs you have to compare. One is FMV of what you have sold. What you have sold, the entire branch, means all the assets in the branch. Find out the FMV of all the assets in the branch. Two, what you have received against this. You may have received money, debentures, shares. Generally, this happens in, you have sold this in accounts. In purchase consideration, you get shares, debentures of that new company. So find out the FMV of the shares, debentures, bonds, whatever you have received, plus the money you have received. So two FMVs you are comparing. FMV of what is sold and FMV of what is received. Higher of the two FMVs is your full value of consideration. So let us say that is 500 crores. Legal expenses on executing this sale is 5 crores. So net consideration is 495 crores. Now what is cost of acquisition? Section 50B says cost of acquisition in case of lump sale is again of the entire branch. And what is the cost of the entire branch? It is the net worth. How do you find out net worth? The assets in the branch minus the liabilities in the branch. Now, what is very important is while taking the assets and liabilities, the provision says you will take only the book values and book value excluding revaluation. So in accounts, you would have done revaluation that you will exclude. Similarly, if you remember PGBP, then in PGBP, for certain capital assets like Section 35 AD business, scientific research, for all these, the cost of acquisition is nil. Why it is nil? Because the entire cost of a scientific research asset or the entire cost of the asset used in 35 AD business is already allowed to you as deduction in PGBP. If the entire cost is allowed as deduction in PGBP, what is left over here is zero. Next, for all those assets which are depreciable assets, what you will take is WDV. So what is important is that while calculating the cost of acquisition of the branch, you have to take the net worth. And for this net worth, you have to take assets minus liabilities book values. Book values excluding revaluation, point number one. Second, for some assets, it will be nil. And for depreciable assets, the book value that you are taking is WDV value as per income tax. Liabilities, the book value is taken. Net of this assets minus liabilities is net worth minus net consideration, that is your capital gain. Most important, long-term, short-term is decided on the basis of the life of this division. Life means for what time this division was with you. So if you are operating this division for more than 24 months, it will be long-term. If you have just started the division and sold off the division before 24 months, it will be short-term. Then two more things that we discussed as special provisions. One is indexation. This indexation provision was earlier applicable to all assets, all long-term assets. But earlier up to when? Before 23rd of July 2024. So if you are selling any capital asset before 23rd July 2024, for all the assets, obviously subject to some exceptions, for all the long-term assets, subject to some exceptions, the law said we will not deduct the actual cost. We will convert the actual cost of acquisition and improvement into index cost of acquisition and index cost of improvement, and that will be deducted. And how indexation was done? It was done by taking the inflation values, which is called as CII, cost inflation index values. However, in the previous year, after the election results, we had the second budget. And in that budget, from 23rd July 24 onwards, this concept of indexation has been removed. However, I'd also mentioned that for resident individuals and HUF, plus what they are selling is long-term capital asset being land or building. So when these two conditions are satisfied, that you are resident individual HUF, what you have sold is long-term land or building, only while computing tax. That is not when you are computing capital gain. Capital gain will now be computed for all assets without indexation. Keep this in mind. Only when you are computing tax. So let me write it here. Only. This is very important. Only when you are computing tax, not when you are computing capital gain. Capital gain will now be computed always without indexation. Only when you are computing tax, you are given option. What option? You find out tax at the rate of 12.5% without indexation, or tax at the rate of 20% with indexation. And then you can obviously take the option whichever is beneficial, and which will be beneficial where the tax liability is lower. So only when you are computing tax, at that time you will do indexation. Next special provision. Next special provision or special computation provision is related to non-resident. This is given in the first proviso to section 48. Remember students, 48 is the computation provision. It says that if you're a non-resident and the long-term capital asset you have is shared debentures in an Indian company, most important, while purchasing you had paid the amount in foreign currency. So for such assets, when these are sold, even though the values that you are having is in rupees, but you will convert them into the foreign currency with which you had purchased the asset. So you will first calculate the capital gain in foreign currency and then reconvert this foreign currency into Indian rupees. So for this, you will take telegraphic transfer buy rate, telegraphic transfer sell rate. These are the foreign exchange rates. You will take average. So average, average, average. And for this conversion, you take the telegraphic transfer buy rate. So this is how you will convert the values and find out the capital gain. So these are some special provisions. Now today we will deal with the last part, which is computation. One is exemption and one is full value of consideration. We'll deal with this today. And after dealing with these provisions, I'll take you to the workings. Now let me first take queries. There are many queries. Prerna says, sir, could you please clarify the reasoning behind comparing the value with SDV? I'll come to that, Prerna. Good question. Because in FPC also we have stamp duty. I'll come to that. I'll explain that point at that time. Navneet, you are asking, please explain right share concept. Okay. See, what is a right share? Right share means you want to know what is a right share, or you want to know what are the provisions of capital gain for right shares? What do you want to know, Navneet? Acha, so provisions of capital gain. See, for right shares, firstly, there are 2 points. See, what happens if you are a shareholder? Company law says whenever a company is issuing new shares, it has to compulsorily first offer the shares to its existing shareholders. This offer is called as a right. So the existing shareholder is given the offer, Ki Baba, I am issuing new shares. Do you want to purchase? These rights, if you want, you can exercise the right. That is, you can purchase the right shares using these rights. Second, you don't want to purchase, you can sell these rights to me so that I will get the right or the preference to purchase the shares of the company. Now, when you are selling the rights to me, Again, what you have sold is a right, which is an intangible asset. So you'll have to compute capital gain on that. For you, the cost of acquisition of right is nil. It is like this rule. What is this rule? This rule is of intangible assets. In case of intangible assets, if it is self-generated, that is, you have not purchased, it has generated over a period of time, it is called as self-generated, the cost is nil. Same logic is applied here. So for rights that you have received, the cost of acquisition is zero, right? Now, if let us say you exercise the right and purchase the right shares. Now, when you purchase the right shares, companies go on not giving it to you free. It is not bonus shares. So for right shares, you also have to pay something to the company. That is your cost of acquisition, whatever you have paid. So for right shares, the cost of acquisition is what you have actually paid to the company. Now in right shares, there is an interesting thing. What is that interesting thing? If you purchase the right shares, you are the original shareholder who got the right. So you purchase the right shares by using these rights. So you pay, let us say, 100 rupees to the company. So for you, cost of acquisition is 100. But let us say in the second case, you don't want to purchase these shares. So you sell the rights to me. Now you have sold the rights to me for rupees 20. So for you, firstly, you compute capital gain of 20, 20 minus nil. So for you, capital gain is 20 on sale of rights. Your chapter is over. Now I have purchased the rights for 20. And now using the rights, I go to the company saying that, see, it was Navneet's right. He is your present shareholder, but he has sold that right to me. So now give the shares to me. So the company says, okay, so now if you have the rights, I'll sell the shares to you. Now the company sells the shares to me for 100 only because the price of the share kept by the company is 100. What will be my cost of acquisition? It is 100 plus 20. So again, rule is same. For me, the cost of right shares is my actual cost, but now my actual cost covers two things. 20, which I paid to you for first getting the rights, and then 100, which I'm paying to the company for getting the right shares. Fine now, Neet. I hope your query is answered completely. Yes, Prerna. So see, in case of rights, see, you already have some shares. You are already the shareholder of the company. So what you have is old shares or the original shares. Now when the company is issuing further shares, new shares, company is giving you the right because this is what is given in the Companies Act. So it is giving you the right means preference. Ki before I go to the public, I'm giving you all the preference that since you are present shareholders, you only purchase my shares. This is called as rights. So since these rights are self-generated, you have not purchased it, you got it automatically because of operation of the company's law. Hence these rights, the cost is zero. And if you are purchasing the right shares, you have to pay 100 rupees to the company. So in case of right shares, which you have purchased, the cost is the actual cost, that is 100 rupees in my example. It is me, Navneet. See, you are the original shareholder. You got the right free of cost, but you don't want to purchase the right shares. Now, I'm your friend on some katta when we are sitting having chai and coffee. You were discussing here, "Hey, I received this right, but I don't want to buy the shares." Then I said, don't, no problem. You sell the rights to me. I will buy the shares. So you sell, which is called as a renouncement of right to me. So you get that 20 rupees by selling the rights to me. Now I have that letter of the company, which is the rights. You have renounced, you have sold the rights to me. So I have firstly purchased the right for 20. And then when I go to the company to purchase the shares, it is again charging me 100, which is the price of the shares. So for me, the cost is 120. So had you purchased the shares, for you, the cost would have been 100 because rights were free to you. But you, the original shareholder, is not purchasing the right shares, but you are selling the rights to me. So now I become the owner of the rights. Now I can go and purchase the right shares. So for me, the right shares are for 120. I hope it is now clear to everyone. Sir, how to differentiate tax treatment when land building? See, Nagaraja Beda, if land building is transferred before 23rd of July, simple difference is indexation is applicable always. In fact, that is applicable for all long-term assets and land building also. But if land building is transferred after 23rd of July 24, in that case, indexation is not applicable on any assets. In fact, even for land and building, indexation is not applicable. First, keep this in mind. It means while computing capital gain, you will not do anything of indexation if the land building is sold now. Secondly, when you reach the final stage, you have done entire computation, everything is done. Now you want to compute tax. Now, if you are resident, individual resident HF, you have sold land building which was purchased before 23rd July but sold after 23rd July, you are given the option only in tax computation that you can do it. Means so you'll do two parallel computations with indexation, without indexation, and you find out tax. Wherever you are benefited, that is your answer. Right, Nagraja? Yes, Navneet. So if you are selling the rights to me, for you 20 rupees is the gain because 20 rupees is the sale value of rights and cost is nil. Correct. And 20 rupees, which is your gain, is my cost. And when I purchase the right shares using the rights, for me the total cost is 120. Kuldeep says, so right share purchase on some cost and it will be part of consideration. Huh? Consideration? Kuldeep, what did you ask? I didn't get. When you have purchased the rights shares, whatever you have paid is the cost, na? How it can be part of consideration? So students, we studied up to this point in the previous class, which was slump sale. That is all provisions relating to cost or up to cost is complete. Now we will proceed with the last part, that is full value of consideration and exemption, and then we will go to sums. Just give me a minute, please. Just a minute, please. Now, what is the provision for full value of consideration? See, firstly, you have the general rule. What is the general rule for full value of consideration? The general rule, which is given in section 48. What does 48 says? What is full value of consideration? Firstly, in simple words, full value means your sale price. For simplicity, keep in mind sale price of the asset. What does 48 says? It simply is the money that you are receiving plus if as a consideration the opposite party has not given you money or along with money has also given you something in kind, then it will be the FMV of whatever assets or whatever you receive in kind. So general rule is, what is full value of consideration? It is the money plus the FMV of whatever you have received in kind, right? Now, again, again, there are exceptions, or you can say special provisions. What are these exceptions or special provisions? Section 45(1)(e), which applies to insurance claim. What is full value? It is the claim received. Now, how can the claim be received? It can be received if in money, then money. And if in claim, the insurance company has given you asset, then FMV of asset. Then 45(2). What is 45(2) dealing with? It deals with conversion of capital asset into stock in trade. If you remember, this is also treated as transfer. Now, what is the full value in case of conversion of capital asset into stock in trade? The full value is FMV on date of consideration. Then 45(5). What is full value in case of 45(5)? Firstly, 45(5) deals with compulsory acquisition, where government or any other person under some law is empowered, authorized to compulsorily take over your property for some public utility purpose. Now, in such cases, what is the full value? It is the compensation fixed. So see, general rule is whatever you will receive, money or FMV of asset received is your full value. Then you have some special provisions. Now, in the list of these special provisions, now 46(2) is there, but I'll explain that later when we come to that point, because for that you need to know some background. Now, what we are discussing right now from your module is 50C. Now, what is 50C dealing with? And here I will also answer one of the questions asked by Prerna. So firstly, what is 50C? This I had already explained when we were studying PGBP also, if you remember. So we have studied this in PGBP where it was section 43CA. Now what is this PGBP? Section 43CA and here section 50C. Now both these sections or both these topics apply whenever what you are selling is land or building or a combination of two, like a flat which has building component also and land component also. Now, what is interesting, Prerna, now I'll be answering your question, that over a period, government observed that there was a lot of black. Black means people were hiding their income from the government to evade tax. Now, what the government observed, that your actual sale price or the agreement value that you have decided with the buyer, let us say is rupees 2 crore. But what you are showing on paper is only rupees 1.2 crore. So your actual sale price is something higher, and what you are showing on paper, that is on the sale deed which is made for such transactions, is lower. Now, by showing a lower price, the seller was avoiding income tax because the seller would have got income tax on this sale, and the buyer was avoiding stamp duty. So both were benefited by showing the lower value. Now, firstly, the state governments who get stamp duty came up with a concept that, okay, this is what you are showing on your document. We will find out our own value, which is the stamp value. Now, what is the stamp value? Stamp value is the value which is computed by the state government for the purpose of computing stamp duty. And what they said, that we will now find out the stamp value and we will compare your price which you are showing on paper with our stamp value. So see, understand this, students, this is not known to government. This I have just told you. So what you are showing is, in fact, you can call this as your agreement value also. So this is what you are saying to the government that, see boss, I am doing the sale for 1.2 crores of this land building. Nobody knows this 2 crores because this is what you are hiding. So I am doing this transaction. I am agreeing for 1.2 crores. The state government said, fine, no problem. You are agreeing for 1.2 crores, fine. But we will compare it with the value which we are fixing or which we are calculating. And if your agreement or sale value compared with our stamp value is lower, let us say the stamp value which government has found out is 1.8 crores. So they say stamp duty will be applicable on this. Or in simple words, the rule was, or the rule is rather, for stamp duty, whichever is higher. Your value, which you are showing, and our value. Now, this protected the state government when they were charging stamp duty on the same transaction. Now comes central government, where it is income tax. Now, in income tax, if this land and building is your capital asset, then you fall under capital gain chapter, section 50C applies. If this is your stock in trade, why? Because you are dealer, builder, developer of properties. So for you, this is PGBP head and section 43CA applies. Now in both sections, 50C and 43CA, which deals with sale of land building, the answer is same. Now what income tax is saying, we will follow a similar logic. So what is the logic? Whatever you are showing as your sale price, agreement price, whatever, we will again compare with stamp duty value, which is already given by state government, so that central government need not do. Now what it is saying, we will not directly take whichever is higher. So now the rule here is, so there is your sale price and there is stamp duty value. Now the government says, so this is scenario one. Let us say your sale price that you are showing is 100 and government stamp duty value is 90. That is lower than sale price. Then what will be considered as income under 50C or 43CA? Not income, the sale price. It will be your sale price because it is higher. Second possibility, you are showing 100, but stamp duty value is 107. Now, when the stamp duty value is higher, they will not directly take stamp duty value. They say, we will find out an artificial value, which is 110% of your sale price. This is just for comparison. Now, what is this 110%? It will come as 100 plus 10%, so 110. And they say we will compare the stamp duty, which is higher, with this value. Now, when stamp duty is compared with this 110%, and now the 110% is higher, the law says we will take your sale price as the value in 50C, that is capital gain, and in 43CA, that is PGBP. But third possibility, that my stamp value is higher, and it is higher even from the 110% value. So stamp duty value is higher even when compared to that 110%. Now the stamp duty value will be taken. So this is what is this whole 50C. This whole 50C, what you are seeing here, this whole provision is this. Correct? So Prerna, I hope you also got your answer that why we are comparing with stamp duty value, because there was some evasion. Correct, Nagaraja. But what is this 9.9? I didn't get your 9.9. I don't know, Kuldeep, what it is called in Gujarat. At different places, either it is called as stamp value, either it is called as circle rate, or it is called as the one more value, one more word I heard somewhere. So it is the circle rate, it is the stamp value, and one more word. I don't know whether it is called as Jantri in Gujarat. I'm not aware, but no need, we'll come to that point. Allow me some time. Let us digest the provision layer by layer. I cannot jump to everything at once. Let people digest this. I'll come to that. So Nagaraja, what is 9.9 SDV? Where is 9.9 in my example? How you are getting 9.9? This is what I'm asking. 110% you don't have to do of SDV. 110% you have to do of the sale price that you are showing and compare it with SDV. Okay. So students, this is what is the provision even under PGBP, that PGBP will take sale value of the land building as this, what we have computed, these three possibilities, and even capital gain will take the same as your full value of consideration. This applies to the transactions of land building. Now, there is a fourth possibility. What is this possibility? Same possibility like third. Now here, as we concluded in third, the answer taken will be 125 because this is higher even from the 110% value. But you feel that this is exorbitantly high. There is no such value right now applicable in reality. Means the stamp duty value is exorbitantly high. It is incorrect. So now the law has provided you an option, an opportunity that you can request your income tax officer, who is also called as assessing officer, to refer your case to a valuation officer. So where you feel that the stamp duty value which has to be taken now as per both these sections is exorbitantly high and the real market prices are not that high. So you can request the valuation officer, sir, you kindly compare and find out the two values. Now in this case, there are two possibilities. First, the valuation officer computed a value which is even higher now compared to what? Stamp value. So your answer will be, no, Baba, let stamp value be the answer. You are much better with stamp value than taking 140. But let us say he computed a value which is lower than the stamp value. So you are comparing stamp value with the valuation officer's value. If the valuation officer value is higher, you will take stamp value. If valuation officer's value is lower as compared to stamp value, so you will take the valuation officer's value. So see, case 1, your sale price. Case 2, your sale price. Case 3, stamp duty value. Case 3, modified stamp duty value. Case 3, modified valuation officer's value. Is this clear, students? What valuation officer charge? See, the person, valuation officer, is an expert of valuation. Whenever the case is referred to any expert like you and me, tomorrow we are going to be experts. You can also do the valuation course and get a certified valuer certificate. Then cases will be referred to you. If you're ready to do it free, definitely my all cases I'll take to you, beta. So let me know if tomorrow you'll do the valuation free after becoming a valuation officer, Navneet. I'll forward all my cases to you. So Neeraj, it will be, yes, you can say whichever is lower. Who will pay, Navneet? It is the assessee who has to pay because assessee is getting it done for his benefit. He is requesting, so it is he who is going to pay. So these are the different possible values, right? So see, the valuation officer point is somewhere here. So valuation by valuation officer is greater than stamp value, you take the stamp value. But if valuation officer's value is less than the stamp value, you take his value. Correct? But an indexation has nothing to do with these values, Mustafa. These values are sale values. Indexation is done of cost. So sale values we are deciding independently. Indexation point was relating to cost of acquisition. This is sale value. This is full value of consideration. And it has nothing to do with indexation. Correct? Okay, fine. बस Aditya, you will apply for valuation whenever the stamp value you feel is exorbitantly high. So your value is 100, stamp value is 125, which is very high, and you feel it is incorrect. Such value is not there today in the market. Means today's market prices are lower because of some, you can say, economy is going slow, or there is a lot of global tension because of which real market prices are low. And hence you did your agreement for a lower price. So in such cases, you can always apply for valuation. Now, after all this, there is one interesting issue relating to the stamp duty value. So now, which value has to be taken so that we have understood? Now we come to stamp duty value point. Now, there is a possibility that stamp duty value may be calculated at different dates, and on different dates, the stamp duty value may be different. Why? Because every year the government revises the stamp values. So in some states it will be revised today. Today is 1st of Jan. So some states are revising today. So what was the stamp value up to last year, that is up to yesterday, will be changed today. In some states it is done from 1st April. Some states may do it after 2-3 years. So every state has their own rule of deciding stamp value. But let us say, for an example, my state is revising the stamp duty value today. Now, interestingly, what is the situation? I did the agreement on 21st of November 25. And finally, my document, the registry, is done on. Now, these things are very common in a land building transaction. So, what is it? So, let us say I'm purchasing a plot of land. This deal is with you. We discussed, we met, and on 21st November 25, that is last year, we concluded that you are going to sell me this land for rupees 2 crore. This is our sale price agreed between you and me. But when we agreed on this date, I requested that 2 crores is a huge amount. I'll need some time to arrange the money. I have some my personal funds, but I have to arrange the remaining funds either by way of loan or from personal friends, relatives. So you said, okay, fine, take 6 months. But today you want me to confirm this transaction by paying token. So I said, fine, I will pay you 25 lakhs so that our deal is confirmed. So today on agreement date, I have paid token advance of rupees 25 lakhs. And finally, after arranging the balance fund, I give you the balance money. And then finally on 5th of March 26, we sign the sale deed and the transaction is closed. I pay you the money. You transfer the property to me through the sale deed. Now, interestingly, between these two dates, the stamp duty value changed. The stamp duty value on this date was 1.95 CR. On this date, it is 2.25 CR. So the stamp value changed. Now here, as you saw in the original provision, our sale price has to be compared with stamp value. And on that basis only, we will determine what is the final value that has to be taken both in capital gain or PGBP working. Now there will be a big change in the answer. If I take this stamp value, 2 crore, which is my sale price, will be considered as the final value for all computation. But if I have to take 2.25 CR, in that particular case, 2.25 CR will become the value and there will be huge difference in the tax. Now the question is, which date's value has to be taken? The date on which we agreed or the date on which the transaction is completed by sale deed. Now here, the law says, well, we are ready to take this date's stamp value for comparison. But what is the proof that you all did this agreement? The proof is there is some token advance. Now, the law says best. You are saying that on this date, you made the transaction and you have paid some token advance. Now I want some authentic proof that the token or advance was paid on this date. And for this, the law has put the condition that whenever any part of the consideration is paid, whole or part, generally it will be part, which we call as token or advance, it should be paid by account pay check, account pay bank draft, or by the electronic prescribed mediums of these. If this token advance is paid by any one of these mediums, that is by way of account pay check or draft, or by way of the prescribed electronic modes, we will take this stamp value for comparison, and then whatever will be the answer, that is already decided as per our provision. But if this token advance is paid by cash or even by way of a bearer check or even by way of a cross check, but it is not an account pay check, then we will not take this stamp value. We will take this stamp value for comparison. So what is the law saying? The law says that which dates stamp value is to be taken, that depends upon the manner in which this token or advance was paid. I hope this is clear. Pirena, I have already mentioned stamp duty value is notified by the state government. It is notified in their gazette. You have to go to your city's registrar office. In registrar office, there is a register maintained where area wise they have given values. Now, in many states, they have converted this register into an electronic record. So you have to go to the registrar's website of your state. You will type, let us say, I am from Maharashtra, so I will type Maharashtra State Registrar, and in that I'll put my area's name and I will find that value online. Or I will physically go to the registrar office in my city, wherever it is located. Generally, it is near the port premises, generally, but wherever it is located, there you find a register in which the stamp values are mentioned. Mustafa has put a very big query, but I'll request everyone that whenever you all are putting the queries, now please put it as a general message so that others will also understand when I'm answering your query. So Mustafa is saying, first we have decided with this selling price, okay, and 12.5% taken without indexation, 20% with indexation, and then for a cost of acquisition, either the expense we paid at that time we can minus from tax and we have to get. But why you are confusing, Mustafa, and why you are hasting? We are discussing the provision, and I've already mentioned that we are going to go to the practical question. I think all your queries will be settled after half an hour. So please don't ask me a question which we are anyways going to cover in the form of a practical example, because anyways your question is confusing for me. And even if I understand and try to answer, others will not understand anything. Neeraj, if on sale deed date SDC is 190, 180, the law will say that they will take 1.8 CR. Huh? In my example, beta, achha, so you are saying it is reduced. See, law has nothing to do with increase or reduction. Law has given you the provision. Now here, what you will do, law will not do anything. Law has already said that if you have done payment like this, you will take that date's value. If you have not done payment like this, we will take today's value. What you will do, you will not show that payment is done on that date. Simple. Because for you, what is beneficial is today's value, not the earlier value. But practically, this will never happen, beta, because practically, what I have seen till now, all states are always upward revising. So nobody is doing backward revision. Prerna, but why is this the case, sir? How and why would the change in payment mode affect the transaction? But a transaction is not affected, Prerna. Please understand. You are claiming that your transaction was done at an earlier date. Fine. But what is the proof? How will I believe? Otherwise, what will happen, Prerna? Understand. Everybody is doing transaction today because today onwards also transaction are going to happen. But to get the benefit of lower stamp duty value, people may give a fraud statement, or they will claim that nee, we had agreed this 2 months back, we had agreed this 3 months back, so that they get the lower stamp value. But what is the proof? So the proof is I want some tangible proof, and the tangible proof is something happening through bank. That is why this provision is there. Navneet beta, that is only for insurance, medical insurance under section 36(1). Correct? Nowhere else that is the case. Perfect, students. So this is 50C, dealing with land building. Now we go to the next provision of full value. Now these are smaller provisions, simple provisions. Now second special case for full value is when you are selling unquoted shares, in simple words, unlisted shares. Now what does 50C CA says? If you are selling unlisted shares, then for such shares, what will be taken as full value while computing capital gain? It will be your sale price compared with FMV, whichever is higher. So for unlisted shares, FVC is higher of your sale price or the FMV of the shares. So whatever is your consideration you are showing compared with FMV, whichever is higher. Correct? And then comes the last provision, 50D. Now 50D practically will not be useful it will be useful in very rare cases. Why? Because when does 50D applies? The law says where consideration cannot be determined. So you do not know the consideration. In that case, the law says then since you do not know the consideration, take the FMV of the asset. Now this is very strange. Why I said practically it may not be useful? Because practically what will be the case where the consideration is not ascertainable? Because if consideration is not ascertainable, then how did you do the transaction? Definitely in the transaction you would have received something. So practically this will not be applicable. But then the provision is made, it means it has some application. So I'll give you that rarest of rare case where this is applicable. This is applicable where there is a consideration, but the consideration is fixed in such a manner for which valuation is not possible. Example, you are selling your building to me, your property to me. Why? Because you are shifting to US. And what is the consideration for this? You are saying that you are selling this building to me, and as a consideration, I will have to take care of your parents for the rest of their life. And I agree. See, contract can be anything. Now, in such cases, there is a consideration, but the problem is how will you ascertain the value? So, this is that rarest of rare case where there is a consideration which is not ascertainable or cannot be determined, which means it cannot be quantified. So when the value of the consideration cannot be quantified, the law says, okay, no problem, we'll take FMV. So this is where only this provision will be useful. So 50C, land and building, 50CA, unlisted shares, where you have to take higher of sale price and FMV. And then you have 50D, which says where FVC cannot be determined, you take FMV. So these are the various provisions of FVC. So general rule under 48 is whatever you have received money, or if something is received as asset or kind, take the FMV. Special cases or exception cases, insurance claim, the claim received, which can be this only. If you are converting capital asset into stock in trade, FMV. In case government or any authority has acquired your property using the powers given under some law, the compensation fixed. In case of 50C, land and building transaction, you have to compare your sale price with stamp duty value and then take the final value. 50CA for unlisted shares, it will be higher of your price or FMV. And 50D, where your full value cannot be determined, take the FMV, right? Now a special provision. What is this special provision dealing with? This is dealing with a case where, let us say, I want to sell my building to you. We entered into some negotiation. In that negotiation, we fix that, okay, I'm ready to sell my building. And let us say we fix a price of rupees 5 crore. You again request me, ki, sir, give me some time to arrange this money. I said, fine. But then if I'm waiting, give me some token or advance. So you give me an advance of rupees 20 lakhs. And I'm ready to wait. So we have entered into a negotiation. There is some agreement. I'm ready to sell my building and price is also fixed. But you want some time to arrange the money. So I take some token advance so that I'm also assured that you will be buying this building. Now, for some reason, after some time, you come back to me saying that, sir, sorry, I don't want to buy this property. for whatever reason. I said, okay, but then whatever advance you have given to me, I am going to now forfeit your advance. I'm going to retain it and not give it back. So if this advance is forfeited, so now I'm having your 20 lakh rupees, which I'm keeping with myself. Now, interestingly, today I have not sold the asset to you, but now this 20 lakhs is my money because I'm forfeiting it, I'm retaining it. In such cases, the question is, what will be the tax treatment of this 20 lakhs? I'll repeat one important rule. Remember, students, don't have this impression that any money received will be taxable. Any money which is income will only be taxed. Anything which is not income cannot be taxed. Then the question is whether this 20 lakhs is income. Technically, the answer is no. Why no? Because for anything being income, it has to be give and take. Only when I'm giving something, like here in case of capital gain, I'm giving my capital asset. In case of PGBP, I'm giving my services or I'm selling my goods. Or in case of salary, I'm giving my labor. Until unless I give something and earn something, it is not income in the general sense. But then comes income in the special sense. What is income in the special sense? Wherever the law has made a special provision, you have to then follow the provision, do that. Now, what is the special provision? You have a section 51. Now, this section 51 is linked with a date. Now, what is the rule? If this amount which I have forfeited, if I forfeited before 1st April 14, then the law says whatever is my cost of acquisition of this building, I have to reduce this advance forfeited from it. So my new cost of acquisition will be a lower cost of acquisition, which is after subtracting the advance forfeited. So the provision is, if I forfeited the advance before 1st April 14, the law is, or the rule is, I will subtract this advance forfeited from my cost of acquisition, and this will be my new cost of acquisition, which will be slightly lower. Second possibility, I forfeited the advance after 1st April 14. Now what will be the effect? No change in my cost of acquisition. Rather, this advance forfeited is my income from other sources under section 56(2)(9). So, depending upon the date of advance forfeited, the law has given two taxability provisions. One is reducing from cost of acquisition. Two, not changing cost of acquisition, but simply treating that advance forfeited as your other sources income. Simple. So in your exam question, you have to be very particular about what is given about the date of advance forfeited, and accordingly your answer will change. Yes, beta, I'm trying to unmute you. Neeraj, whatever you hide is black money. Yes, beta, I'm trying to unmute, but I'm not able to unmute. Manishji, can you unmute? Mr. S? Okay, fine. It may be by mistake then. Let us proceed. So this is what is the special provision relating to advance forfeited. See, here they have given it in the form of, beautifully in the form of table. So advance which is forfeited before 1st April 14, it will go to reduced your cost of acquisition. And if it is forfeited on or after this date, no effect on cost of acquisition, rather this will be taxed as your income from other sources. And then we come to exemption. As we discussed at the start today, when I was answering somebody's question, I think Neeraj had this question. So exemption, section 10 provides exemption to all incomes, including capital gain. And then capital gain also has some special exemptions, but these exemptions are only if you reinvest. Now, this reinvestment will come first when you get capital gain. So today we are not going to study 54 at all, because today we have to first make ourselves comfortable up to reaching the amount of capital gain. Once we reach the amount of capital gain, then will come the next point as to whether there is exemption under 54, because for that you will have to reinvest. But first, today we will reach up to capital gain, because anyways 54 will come later. But before that, you have to know section 10 exemptions, because section 10 is that exemption where if your case is falling under section 10, that amount is exempt right from the start. So by default, you can say it is as good as no computation required, because the income itself is exempt. Now in section 10, there are multiple exemptions. What is applicable to us is 1037. Now we studied right from day one that compulsory acquisition is taxable as it is treated as transfer. So there will be taxability when compulsory acquisition happens. However, there is a specific case which is exempted. Now, when you read and understand the logic, it will be easy to remember. So let us say the government is now setting up bullet train. Now for bullet train, this is the entire route which is planned. Now on this route, to set up this entire railway track and the stations and everything, the government needs the land. Now here is my land, here is your land. Now both these are on the route. Now the government has special powers to compulsorily acquire the land. So government has acquired my land, fixing the compensation as, let us say, 2 crores. Government has also acquired your land, fixing the compensation as 5 crores. So firstly, both of our cases falls in the definition of transfer. Both of our properties are capital asset. Now comes the exemption. My land is a commercial land or a residential land, and your land is a agricultural land. Now first understand this. Whether your land is falling in rural area, if answer is yes, there is no need of this exemption, because you are anyways outside capital gains, because this is not a capital asset. But your land is not falling in rural, it is falling in urban, because this patch is urban. Now if it is urban area, your agricultural land is a capital asset. But then section 1037 will rescue you. What does 1037 says? That if you are a farmer, obviously agricultural land means you will be farmer, and your agricultural land, which is in urban limits. Why urban limits? Because if it is in rural, anyways, there is no tax, because rural agricultural land is not a capital asset. So it is in urban area and it is compulsory acquired. Then the law says there will be no tax, because section 10 is exempting this capital gain. Now this benefit is given subject to two conditions. One, the owner, that is the farmer, should be individual HUF. Second, the farmer should have actually used this land for minimum 2 years before this compulsory acquisition for actually doing agriculture. So see, you may have agriculture land, but you're not using it. Then I will not give you exemption. So basically the ideology is giving exemption to farmers. So if you are having agriculture land and you are actually using it for agriculture for minimum 2 years before this compulsory acquisition happens, then there will be no tax on this compulsory acquisition. This is fine. Perfect. So with this, we have completed 90% provisions. Now what is left is 54, but as I said, this we will deal with later. First, we will understand, we will study how to compute capital gain in different scenarios. And then in the next class, we will deal with 54 exemption, which is for reinvestment. And the last part, which is the tax computation. Though in these topics, we are not going to study the total tax computation because we have a separate chapter on tax computation. But for capital gain, there are some special provisions for tax computation that we are going to discuss. So we have completed 90% of provisions, only 54 and tax rates are left. That will be done in the next class. Today now we'll be solving some questions. But before that, let us take our break so that there is some mental break also. So 15 minutes, we are having our break and then we'll come back and we'll solve practical sums. Fine. Chalo then. Let us go to the practicals. Now, before I start with sums, some important things, students, I want you all to develop as a habit and also to follow. See, if you would have seen, when I was teaching PGBP, the approach was different. When I came to capital gains, one thing which is common in PGBP and capital gains is there also I had summarized the provisions. Here also I am summarizing the provisions. See, the only difference is here the provisions are summarized in some categories or sections like charging section, format, then some golden rules, then computation in special cases, then charging section and exception, cost of acquisition and exception, cost of improvement and exceptions, special cases of computation, then full value and exception, exemption. So here we are studying provisions in categories. In PGBP, we were studying provisions like debit side, credit side, within debit sides, the general rule and exceptions, and then the restrictions. So different topics should have different approach. Then when you come to practicals, now what is very interesting in PGBP, when you are doing practicals, you are required to apply all the provisions in the same sum, because in the same sum, when you have multiple items on debit side of the P&L and credit side of the P&L, you have to apply majority of the provisions in the same sum. However, in PGBP, that will not be the case. In PGBP, you may not be required to apply all the provisions at the same time. So what I have done is I have created my own category of you can say PGBP provisions handout, which I'll be sharing at the end. But first, I would like to show you how you should study the topic. So see, this is the sums that we are going to deal with in a while. Before that, now see what I have done. I've created a summary. Now this summary is mainly the practical summary for capital gains. Theory we have already done. Practical. Now practical is this format which remains constant throughout capital gain chapter. This format will not change. Now this format is as per section 48, which is the computation section, read with the charging section, which is the main charging section 45.1. Now what is your format? Format is you start with full value of consideration. Firstly, rather, you determine whether it is asset or not, whether there is transfer or not, because only then when both these conditions are satisfied, 45.1 will apply. So you first determine these things, asset and transfer. When both things are satisfied, the next thing that you will decide is what is the nature of asset, long term or short term. And then accordingly, the format applies. Now, what is the format? You start with full value of consideration. Full value, as we saw, is in 48. Plus, there are some special provision in 45. Plus, there are some special provision in 55. So these are the different sections. Sorry, not 55, 50. These are the provisions relating to full value of consideration. Then minus expenses on transfer. This is very simple. Any expense which is relevant, which is related to the transfer, will be subtracted. In this one very important exception, STD paid will not be allowed as deduction here. Then the difference is net consideration. From this, you subtract cost of acquisition. The main provision is in 55.2, which says cost is your cost. Plus, if any expenses are incurred on at the time of purchase, that will also be included in cost. And then you have special provisions in 49, 50, 51, 55. Cost of improvement, main provision is 55.1b. And then there are two exceptions where the cost of improvement will be taken as nil. One, for intangible assets, it is nil. Two, for assets acquired before 1st April 2001, if any improvement is done before 2001, that will be taken as nil. The difference between this is your capital gain or loss. Today, we will do up to this point, that is up to the point of determining the capital gain or loss. And after you have reached this, and if it is a gain, then in the next class, we'll go to the reinvestment provisions, where under different provisions of 54, if you reinvest as per the conditions, you will get exemption, and then finally you'll have the taxable capital gain, and then we will also study the tax rate. So these are the only two things which is left. One is the exemption on reinvestment and the tax rates. Now, what I do, students, is for the purpose of practical, this is my way of even studying at the time of my exams, and that is what I'm trying to forward to you all. I make category of some special scenarios where some provisions are there, and these are the provisions which you will require regularly. So one is asset which is acquired under section 49(1). What is 49(1)? Where you get the asset by way of gift, will, inheritance, holding, subsidiary, etc., which is not transfer. What is the important point? The period of holding. When you are counting, the period of holding will include period for which the asset was held by the previous owner. This is important. Remarks golden rule 1. What was golden rule 1? Your cost will be cost of previous owner. Further, if the cost of previous owner is not ascertainable, then you will take FMV as on the date of acquisition by previous owner. Cost of improvement, both of yourself and of previous owner, both will be considered. Second special scenario, if asset is acquired before 1st April 2001, what will be your cost? Cost of acquisition will be, in case of land building, higher of actual cost, and compared with this second value, in which you have to take lower of two values, FMV and stamp duty value on 1st April 2000. If it is any other asset, it is higher of actual cost and FMV on 1st April 2001. Cost of improvement before 2001 will not be considered. Correct? Then advance received against an asset is forfeited. We just did right now, just 2 minutes before the break. So advance forfeited up to 31st March, it will be reduced from cost of acquisition. If it is after or from 1st April onwards, it will be treated as income from other sources. Now from here, I have tried to curate different scenarios in which capital gain would be computed. So what you are selling is gold, silver, bullion, jewelry, archaeological collections, drawings, paintings, sculptures, work of art, unlisted shares. For all this, period of holding, 12 months, 24 months rule is applicable. For paid shares, you have the FVC under section 50CA, which is higher of sale price and FMV. Correct? This is only for unlisted shares. Year of chargeability is year of transfer. All other provisions, full value, expenses, costs, etc. There is nothing specific except for unlisted shares. Correct? Then for unlisted bonds, debentures, or market-linked debentures, units of mutual fund acquired on or after this, what was important, students, if you remember, the gain arising from them will always be treated as short term. Baki, there is no other specific provision. Now, this is important. This I have left out purposefully because this is a very special provision. This we will do in the next class, because today I do not want to merge this because this is a very special provision. What it deals with, long-term capital assets. What are they? Equity shares, where STT is paid both at the time of purchase and sale, or units of equity-oriented fund, where STT is paid at the time of sale, that is transfer. But this will deal with later on. Then transfer of asset forming part of block of asset. We did in the previous class. I have also revised this today. Now, computation of different assets under different scenarios. Land building. It becomes long-term after 24 months. Remarks, if it is rural agriculture land, it is not a capital asset. Year of chargeability is year of transfer. What is very important? Full value. You have to apply 50C, which we studied today. So for land building, you have to always remember 50C is applicable, plus for land building, the indexation option is available to resident individual HF if this land building was acquired before 23rd of July 24 and is transferred today. But what is important is all this option and all has to be checked only when you are computing the tax liability. So right now, when you're computing capital gain, you don't have to talk about indexation at all because now indexation has been removed. For intangible assets, again, period of holding for becoming long-term is 24 months. Full value, there is no special provision, but for cost, there is a special provision. What? If it is self-generated, nil. And if the asset is purchased, the cost is actual cost. What is important is cost of improvement is always nil. See, this is how I used to study. So for capital gain, what I have done, I have made categories. And for each category, whatever is the special provision, whether related to full value or period of holding or cost, I have put it at one place. So what happens, students, when you do it in this manner, revising is easy and most important for the purpose of exams. This type of approach will be very easy to retain and your answering would be error-free. So as you can see, I have curated different scenarios, different assets, and for each I have put down the relevant provisions. Is this fine? Plus I have kept blank. So I have copied the above format. So we can keep on adding as we get other provisions, other assets. I hope this is clear to all. Yes, students, all set for practicals. I hope you understood the approach which I just showed you. Please develop such approaches. Develop those things which are going to help you for your exams and for capital gain. This is that approach. I hope you understood this approach. Correct? So you put down the relevant provisions at one place. Also, if you see, I've given the markings of module page number so that in future, if you want to refer it back, you can also refer it back from module. So everything will be at one place. Yes, Kuldeep. We at BOS are always trying to put things in place for you all. Yes, it requires a lot of hard work. It requires a lot of time investment because we have to curate it because these things are not available anywhere in any book. Only we at BOS keep on working, giving you all the approaches in different manner, which will help you all in your professional life also, plus immediately in your exams. But my request is please, you all start having this type of approach for your studies also. For every subject, every topic, try to curate something creative which will be helpful to you for that topic for the purpose of your exams. Yes, definitely, beta, everything will be uploaded. Right now, I'm just showing you because, see, I'm slightly a different type of teacher. I'm sorry for that, Virali, but my approach is not giving everything firsthand. If you would see, even in PGPP, after dealing with the entire topic, then I uploaded or I shared my short notes. Why? Because see, if I give these short notes at the start, there are two disadvantages. One, you will not read the provision in detail from the module, which is very important. Two, a bigger problem is you will not be creative yourself. See, these things I developed for myself. And let me tell you one thing, students, whatever you will develop, that will be the one which is most helpful to you. See, I studied, if I'm not wrong, I studied income tax for the first time in my life, I think in 1999, if I'm not wrong. My first reading of income tax was 1999. This is 2026 today. So nearly 25 plus years have passed. I still recall provisions. I still recall section numbers. I still recall logics. Why? Because I did it myself. See, at that time, we did not have the benefit of coaching classes. So there was no one to even guide us what to read, where to read. I was completely relying only on the Bible. That is our module. And let me tell you, students, it helped a lot. I only refer two things. One is our module and the other is the act, the bare act. Today, in fact, you have everything online. We had nothing online. Rather, we did not have the internets and all these mobile phones were not there. I'm talking about 98, 99. So nothing was there. But that was the best thing, according to me, because it helped me develop my own methods, my own approaches, which is helping me even today. So why? I'm insisting this, why I do not share this beforehand, because I do not want you to be completely dependent on us. See, the more you create things from yourself, the more it will be helpful. Correct? Anyways, this will be shared once the right time comes. Now let me take you to the sums. Again, I have curated some sums so that understanding of the topic becomes easy. Now I'll request that you all first take a screenshot. Fatafat. Take a screenshot of this so that when I'm solving, I may be switching to different slides, but for you, it should not be discomfort. Take a screenshot first. Fine. Next. Take a screenshot first. Done. Okay. Take a screenshot. Done. And then finally take a screenshot. So around 20 sums are curated by me. These will help you cover majority of the provisions with different combinations. Because see, something is special in full value, but cost and other things are regular. Something is special in cost, but other things are regular. Then mix of different things, right? So let us start. Now, what should be your approach? I'll tell you that also. So students, your approach. Sorry, 1 second. I'll not open the Word file. I'll open the PDF. Also, writing on Word is at times difficult. Now, students, what should be your approach? In any question, first check if there is a capital asset. Then check if there is a transfer. Then check if Section 10 exemption is there, because if Section 10 exemption is there, no need for a computation, it is exempt. When all these things are satisfied, there is asset, yes. There is a transfer, yes, means it is not falling in the exceptions of asset or transfer. And there is no Section 10. So minus means Section 10 is not there. Then you will go for computation. In computation, decide the type of asset, that is long term or short term. Decide the year in which you have to tax it. And then go to all the values, full value, expenses on transfer, cost of acquisition, cost of import. So this is how you will approach, right? Fine. Chalo, all set. So Mr. Namo sold his land. Is it a capital asset? Yes. Is selling land a transfer? Yes. Is it exempt under Section 10? No. So it means we are good to go with computation. So now you have to decide the type of asset, whether it is long-term, short-term. Now students, you have to answer me fast. Now for land, for long-term, short-term, what is the rule? 12 months, 24 months. For land, what is the rule? 12 months, 24 months. Super. Very good. Excellent. So all are correct. It is 24 months. Perfect. Perfect. Now, you sold it on 5/10/25 and it was purchased on 10/10/18. So definitely this is a long-term asset. Fine. Now comes the next part. What is the year of chargeability? Year of chargeability is the year of transfer. Now, when is the transfer happening? The transfer is happening in 25/26 PY. That is relevant to AY 26/27. That is what is the current year we are talking about. So question 1. Now, computation of capital gains. Now this is going to be common. Sorry, I'll not do it like this. I'll make it in a tabular form. So computation of capital gains, right? We are in question 1. Now, what is the year of chargeability? It is PY 25-26. So relevant to AY 26-27. Why this is important? You'll get to know that. Now here, which section is applicable, students, for full value? Okay, there are two provisions. One is the general rule 48, or we have special rules for full value. Now here, my handwritten notes, which I was discussing in past 2-3 classes, is irrelevant. Now here you'll go to that section. Which section? Full value. To check which provision of full value will apply, the general rule or there is any special provision. So tell me, students, what will apply for full value here? Tell me the section number. Correct, Nagaraja. No Kuldeep, no Neeraj, no Mustafa, no Hiram, no Divya. Yes, Atitya. Yes, yes, Umi. Correct, Prerna. Yes, Aditya. So it is 50C which is applicable, not 48. Because for land building, the general rule given under 48 is not applicable. What is applicable is our C. What is applicable? Full value for land building. What is applicable? 50C. So general rule not applicable. See, this is how such notes helps. So in capital gain, your note should be like this, divided into each category. So asset, transfer, year of chargeability, cost of acquisition, cost of improvement, exemption, full value. This is how your notes, your short notes should be, correct? So 50C. Now what is 50C saying? We just discussed today. You have to compare your sale price with the stamp value. If your sale price is higher, the sale price will be taken. If your sale price is lower, then you will not take the stamp duty value immediately. You will make your sale price 110 and again compare with stamp duty value. If now this 110% of your sale price is higher than stamp duty value, take the original sale price. But if the stamp duty value is higher, take the stamp duty value. So that is what we will apply over here. Now you are selling it for 110. Stamp value is 112. So stamp value is higher. But whenever stamp value is higher, what you have to do? You have to make this value 110%. So 110% of 1.1 crore will be 1.21 crore. This is 110%, correct? Now this 1.21 crore will now be compared with stamp value. Now this is higher. Since this is higher, you will take your original sale value as the answer. So answer is your sale value, not 1.21. See, this 1.21 is only for comparison. 110% will never become the answer. If this 110% is higher than your stamp value, you will not take 110%. You will take your original sale value as the answer. My 110% is coming as 1.21. It is higher than the stamp value, but I will take my original sale price as the full value of consideration. Correct? So under section 50C. Okay, I'll not write here because this is a common format. So I'm writing here just for your reference. So it is 110 minus expenses on transfer. This is net consideration minus. Is there any expense on transfer given, students? Yes. You have spent rupees 3 lakhs for making payment to the agent, where the agent has helped you arrange the deal. So that is expenses on transfer. Yes, Nagaraja Bida. Nagaraja, tell me.
Voice audible, sir?
Now audible, Bida.
Okay. Sir, as per section 50C applies, STV is more than sales price. So, full value consideration is 1 lakh, 1 crore, 12 lakh.
Bida, is that the rule? What is our rule? What did we study, Bida? What did we study here?
110% of applies on sales consideration.
See, I have the example. My sale price 100, stamp value 90. My sale price is higher, so answer is sale price. My sale price 100, stamp value is 107. Now stamp value is higher. So I will take 110% of my sale price, which comes to 110. I compare both these. Now what is higher? 110. What is my answer? Sale price. Nagaraja.
Yes, sir. Okay.
Clear?
Yes.
So if stamp value is higher, you will not directly take the stamp value as the answer. You will compare it with 110% of your sale price. Correct?
Yes.
And if your 110% is higher than the stamp value, then you will take the original sale price as the answer. So answer here is 1.1 crore, which is my original sale price, right? So net consideration is 1.07 crores. Now, cost of acquisition. The land was purchased for 40 lakhs. Now in cost of acquisition, again, the general rule is what is cost of acquisition? It is your cost. And then there are some special points. If the asset is acquired under 49.1, what is 49.1? You have acquired the asset by way of gift, will, inheritance. That is by one of the modes which is not transfer. Is that the case here? No. Second special case in cost of acquisition is if the asset is acquired before 1st April 2001. Is that the case here? No. It means the cost of acquisition is as per the general rule and it is my actual cost. Now, my asset is long term, it is land. Whether I will index, you have to just write Y for yes or N for no. Whether I will index, it is land, it is long term. Whether I will index, you have to just write Y or N. Kuldeep, how can you answer it like this, Vida? Can you give conditional answer here? I will not index. I will not index. I will not index. Because after 23rd July 24, indexation has been removed from computation. Point number one. So after 23rd July, and Kuldeep, our case is after 23rd July. So you cannot give me a conditional answer. Your answer should be only single. My transfer is after 23rd July 24 because my transfer is happening in 25. And after 23rd July 24, indexation has been removed completely. Right? But then, sir, assessee is individual. Sir, it is land building. There is some indexation. Sorry, even for individual, even for land building, there is no indexation while computing capital gain. At the end, finally, after all heads are done, after set off is done, after everything is done, when you reach the final stage of computing tax, only while computing tax, let me take you back to what I wrote today. See, I have written here also today. What I have written? Only while computing tax, option of indexation and without indexation has to be checked. So this is, or this was applicable. Today, there is no indexation. We understood this in the previous class also. Today also, we revisited this point. I added this word or this part today. So you are individual. The asset is land building. Perfect. But no indexation. No indexation. You will do indexation at the end when you have to compute tax. That also you will check both the options and only the tax whichever is lower will be taken. The computation of capital gain remains same. Computation will be done only without indexation. Keep this in mind. Computation will be only without indexation. Correct? Clear to all? Anybody? Any confusion now? So computation will always be without indexation for all assets, for all assessees, nothing doing. Yes, Aditya.
Sir, when we taken 20% of indexation, sir.
Beta, I've been repeating this. You have to do all that when you are going to compute tax. 20% is what? 20% is tax, na?
Yes, sir. Yes.
So that when we will go for tax computation, we will see na beta. Today, right now, we are only on the income part. That is a capital gain part. In
Yes,
capital
sir. Yes.
gain part, there is no place for indexation. Only when you will go for a tax computation at that time, we will check indexation, right?
Okay, sir. Okay, sir.
So I will deduct 40 lakhs. There is no cost of improvement. So my final capital gain, capital loss, 67. This is my long-term capital gain. Clear? No doubts? Perfect with all? Understood by all? Great. Excellent. Good. Let us proceed. Now, students, I have changed the question. Now let us go to part 2. Yes, Tisha, it will get clearer with practical sums, but before that, we have to be thorough with provisions. But definitely the provisions will be clear with sums, and that is how I have curated these sums. Step by step, I'm going to add different provisions, different exceptions, different carve-outs. Chalo, students, part 2. What will happen in part 2, question 2? What I have changed in question 2, everything is same. I have only changed the date of purchase. Neeraj, what you are saying is almost less than 24 months. How it can be almost? Either it is less than or it is not less than. How it can be almost? Students, be precise in taxation. Shraddha, again, how come indexation has come here? Can you explain? You are saying cost inflation index applicable. Again, the person with the name as dash, you are saying indexation done. What is the role of indexation here? Why? Theasumi, why index is applicable here? Why you all are going to indexation here? Indexation has been removed from the act. And in fact, now, because of change in the purchase date, the asset is held for less than 24 months. And once it is less than 24 months, it becomes short term. Once it is short term, there is no question of indexation at all. Okay, so those who said indexation, maybe because somebody just explained that you took the transfer date as this date. Please read the question, students. I have clearly written what is this date. This is purchase date, not the transfer date. So I have not changed the sale date. I have changed the purchase date, because of which asset is short term. Anyways, the question of indexation is not there for short term even earlier. And today indexation is removed for everything. So in part 2, everything is same. The only difference in part 2 is this is now a short-term capital gain. That's it. Right? Neeraj, beta, I really don't understand what you are trying to do. What is this 23.986 months? What is this, Neeraj? How is it relevant here? Tell me. Is it going to have any impact on any calculation? Arey, but why are you calculating it like this, beta? We only want less than 24 months or equal to or more than 26 months. Why to go in for fraction? Tell me. How is this fraction relevant or helpful in any manner? Please, students, don't get into unnecessary things. Already our provisions are good enough to take you all for a ride. Why you're adding more technicalities into it, finding fractional period of holding? Please don't add irrelevant things in your mind. In fact, if I have to talk about psychology, which is one of my favorite subjects, today 90% or maybe more of your problems is because you all keep on adding unnecessary things in your mind and also keep on carrying unnecessary things on your heart. Please, at least in this year, unload both things. Remove unnecessary things from your minds and unload your heart of unnecessary feelings, unnecessary burdens, hatreds that you all are carrying. You will be more blessed, you'll be more happy, and you'll most importantly more successful. Right? Chalo, anyways, let us proceed. Question 3. Pooja sold her gold. Again, step by step. Is gold a capital asset? Yes. Is selling a transfer? Yes. Is Section 10 exemption applies to this? No. So we are good to go for computation. Now you have to decide the type of capital asset. Long term, short term. So check the purchase date. It is 15th Feb 12. Sale date is 25th July 25. Now for long term, short term, which period is applicable? 12 or 24? 12, 24. Aditya, but I did not get what you mentioned in tangible asset. It was with relation to what? So 12 months rule, 24 months rule for gold. Neeraj, where it is deemed that transfer of gold is short term, please check. And let me know also where you found this. Aditya, what is intangible? Please let me know. See, you all are giving me some very interesting new realizations. Somebody is saying intangible. Somebody is saying deemed transfer is short term. Mustafa, I don't know from where you have got 12 months and you are saying it is short term. Great. 2026 has come up with new realizations for me. For the first time, I'm understanding so many new things. That also about gold. Gold is scaling high. It just went down slightly in past 2-3 days, but otherwise it is scaling high. And you all are also scaling very high. I don't know because of what. But as per my understanding, gold is tangible. As per my remembrance, there is no deemed transfer for gold to be deemed it as short term. What is deemed as short term is only market linked debentures and unlisted bonds and debentures, that is section 50 capital AA. That is only where something is deemed to be short term. Another thing which is deemed to be short term is depreciable asset. That's it. Besides this, nothing is deemed to be short term. Correct? So this is a case fit for computation. The asset becomes long term after 24 months and it is long term. Year of chargeability is year of transfer. So it is 25-26. So we are good to go. So it is 25-26. What is full value? There is no special provision for full value in case of gold. So full value is as per the normal provisions. So there is no special provision for full value. So full value is normal provision. And what is normal provision? 48 says full value is the amount which is received. So that is what is the regular provision. There is no special provision of full value for gold. How much you have received? 75 lakhs. Again, on purchase side, what is the general rule? It is the price at which you have purchased plus expenses on purchase. And then there are special rules. Special rule applies if one asset is acquired under 49(1), that is in one of the cases which is not transferred. That is not the case here. Or it is acquired before 2001. That is not the case here. So both provisions, sale value and cost, both are regular provisions. So 75 and 45. So 75 lakhs. Expenses on transfer, nothing is given. And for cost, it is 45 lakhs. There is no special provisions relating to cost here. Nothing given for improvement. So 30 lakhs. Long-term capital gain. Navneet, what is 50C and 110%? I don't know which. Sorry, this is old chat. Sorry. Okay. Perfect. Next sum. Question 4. Go step by step. Asset. Yes. Yes. Sale is transfer. Yes. Exempt under section 10. No. So we are good to go for computation. What is the long-term, short-term rule here? 12 months, 24 months, students. In this case, long-term, short-term is 12 months, 24 months. Okay, many of you are saying 12 months. Shraddha, how it will be short term, beta? So firstly, 12 months, 24 months. It is 24 months. 12 months is for what? 12 months is for listed shares, not for unlisted. Check. Go back to module. Now see, what you can do is you can go to let us recapitulate for faster reference. You have let us recapitulate the best part of the module, which is now copied by many people in the market. See, what is the rule for short term, long term, 12 months, 24 months? See, where is the 12 months rule applicable? Listed securities or units of equity oriented mutual fund, zero coupon bonds. Is our asset any one of them? No, our asset is here. So it is 24 months rule plus the deemed rule. Somebody was saying that deemed. So this deemed rule is under section 50 capital AA, but this is also deemed applicable for units of specified mutual funds purchased after this date, or market linked debentures, or unlisted bonds and unlisted debentures. Is our asset falling in any one of them? Neeraj, no problem. Provisions will clash. Why? Because it is still the start. I'm okay with this. And that is why I had said, or I had asked you all to revise, because capital gain takes only 2 minutes to solve. Only 2 minutes. But recalling the provisions is the key. The best part of capital gain chapter is you can score 8 to 10 marks or the 6 marks, whatever is allotted in only 2 minutes. The only topic which gives you maximum marks in 2 to 4 to 5 minutes max, because there is no computation. But then what is the challenging part? Recalling the correct provision. How to do that? The only way to do that is repetition. You have to keep on reading, revising the provisions again, 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 again. Are Shraddha beta, why you are going to short term? If it is unlisted, how they are short term? Aditya, even if it is listed shares, how it is short term? For listed shares, 12 months rule, which may be again long term, and for unlisted 24 months rule, which again can be long term. So firstly, is it falling in this deemed? Answer is no. So you cannot directly say it is short term. So it means if it is not in deemed, then you have to apply the rule. Which rule applicable, 12 months or 24 months? It is 24 months. Now check 24 months. When did you purchase? You purchase on 15 Feb 2012. When you sell in July 25. After 13 years. 13 years. Sorry, I'm on wrong point. You purchase on 8th October. You sold on 9th Jan. After around 3.5 years. So, firstly, 24 months rule is applicable. Yes. Is it deemed short term? No. So, deeming is outside. 24 months rule is applicable. And it is more than 24 months. So, it is long term. How can you all conclude short term, Aditya, Shraddha? Correct. Please be patient with the provisions, with the topic. Most important, please study, read, revise. There is no shortcut to that. There is no app for that. There is no AI tool for that. Interestingly, put this in ChatGPT, it will give you wrong answer. That is the best part for you. It means you are safe and secure. ChatGPT will give wrong answer. You can try this today, right? So this is long term. Yes, it is long term. Now, for computation, we require these values. So fourth sum. Now for full value, the general rule is 48. Is there a special rule? Yes. Under 50 CA, there is a special rule for unlisted shares. Yes, Shamli, very good. Nagaraja, but it is not about ChatGPT being updated or not. In fact, maybe I don't know how much you are updated, but what is my understanding, ChatGPT is very much updated. Yes, you can even try on CA GPT, the GPT by our institute. It is not about whether it is updated or not. It is very much updated as far as my understanding is concerned, Nagaraja. The point is, these things are not that straightforward that ChatGPT can answer. So that is the best part for you. You are secured. Your profession, your career is secured, because for such complicated things, even ChatGPT may not give you the answer correctly. And that is where your skill will always be required. This is what I want to emphasize on. Now, what is 50C CA saying? It is applicable only for unlisted shares, where it says full value will be higher of original sale price and FMV. Now, what is the question saying? Our original sale price is 24 lakhs and FMV is 25 lakhs. So whichever is higher you will take. So here my answer will be 25 lakhs. Expenses not given. So now for cost, general rule is price at which you have purchased. Then you have the previous owner rule, golden rule 1. Then you have the 1st April 2001 rule, but all these are not applicable. Why? Because you have purchased it much after 2001. And second, you have not received it by way of gift, inheritance, etc. So previous owner rule is not applicable. So for you, the cost is the actual cost, which is 6 lakhs. So your answer is correct. Long term gain 19 lakhs. Correct. Super. Now what are you all supposed to do? You are supposed to solve the remaining sums by yourself. Maximum what I can do for you as a favor, if I can use this word, is I can allow you to take screenshot of this, but that may not be very much necessary, because you can even refer our modules. Let us recapitulate. But if you want, you can take a screenshot of this. So let me just make it 1 second. Do it like this. Take a screenshot of this first. Chalo, fast. First screenshot is this. Screenshot 1. Done. Now, then you have this screenshot 2. Done. Then you have screenshot 3. 1 second. 1 second. 1 second. Yes. Take a screenshot of this now. Screenshot 3, which has cost of acquisition and cost of improvement. Done. Then this screenshot, important. Screenshot 4. Or do one thing, take this as a screenshot, you can enlarge and see. So this covers all computation provisions at one place. Cost of acquisition, cost of improvement, full value of consideration, everything at one place. You can take a screenshot of this. Later on, you can enlarge and see. Perfect. But if there is a brokerage paid, you have to deduct it. Is there a brokerage which I missed out? Question 4. Okay, I'm sorry. In question 4, I have been informed that there is brokerage paid, which I have missed out. So yes, I'm sorry. Brokerage paid is there. So that will be deducted. That is how much beta? 50,000. No? Sorry, I missed out on this, students. 50,000 is brokerage paid. So 2450, and then final answer will be 1850. Sorry, this is the final answer. Thank you, Hiram. Fine. Students, please study, revise. The next class will be next week. So you have time this weekend. Make capital gains thorough by revising. Use module, use the short notes, and please use all your time, energy, dedicate yourself, right? Yes, Prerana, beta, tell me.
Hello, good morning, sir.
Good morning, beta, tell me.
It's first of all, Happy New Year to you, sir.
Same to you, beta, tell me.
Yes, sir, I don't have any specific doubt regarding the subject. Actually, a few days back in one of the lectures, he had mentioned something about an RRC conference. So I was really curious about that. Actually, I'm a law student in Mumbai, based out of Mumbai. I'm studying in NLU Mumbai, and I'm also doing CA along with it. So I just wanted to know whether like the students are allowed to be a part of such conference or like for learning and being a part of it in general.
Yes, beta, I think, see, there are student conferences also. In fact, this is the
Okay.
best season for having student conferences. So kindly check on our institute's websites. You will have various student conferences. You can definitely attend. And RRCs are very specific. They are for members mainly. So
Okay.
for that, maybe you'll have to wait. But definitely you can attend student conferences, beta.
Yes, sir. Thank you so much, sir.
Yes, and just contact me. I'll give you more details about other conferences where you can attend.
Sure,
Fine.
sure. So definitely. Sure, sir.
Yes,
Thank you.
somebody please put the screenshots here. Some other people have missed out. So if somebody has taken, can you all please put the screenshots here? Yes, everyone. So that was great. We have completed 90% of portion. 10% will be done in the next class. But in the meantime, kindly please revise and you have to compulsorily solve all these questions. Yes, Aditya.
Sir, last question. In the first program, what should we do, sir? 1.21 crore, sir?
Nothing. It is just a value given which will not be used anywhere because as per the final provisions, you have to use your sale price only. So that is only a value which you see. You will be given multiple values in questions. All values have to be used somewhere. That is not the case. Now only the relevant values as per the provisions have to be used. Others you have to just ignore. Correct?
Okay, sir. Okay.
But
Sir,
yes,
in fourth question, which is a higher price? Only we can take in FVC, sir.
that is what is 50 CA saying. Na? So in case of
Correct.
unlisted shares, you have to take the sale price or FMV, whichever is higher. Our FMV is higher, so I have taken FMV.
In
Correct?
every question we can take like this, sir.
No, beta. 50 CA applies only to unlisted shares. So you will take whichever is higher only when the question is of unlisted shares. You cannot mix it with others. Please be specific with provisions, beta. Don't generalize. Right?
Okay,
You
sir. Okay.
cannot apply this rule to all assets. Correct?
Sir, okay, sir. Okay.
Perfect. Okay, students. Thank you very much. Wishing you best career and most important presently the best learning time this weekend. Right? So this weekend, capital gains should become your pet topic. Thank you. Take care. Bye-bye. Yes, Manishi. Good day, sir. Good day.